When an unauthorized transaction occurs, banks follow a structured investigation process designed to protect customers while minimizing financial risk. This blog explains that the process typically begins when a customer reports suspicious activity. At that point, the bank will often take immediate action, such as freezing the account, blocking cards, or flagging transactions to prevent further fraud. The investigation itself focuses on verifying whether the transaction was truly unauthorized. Banks review transaction details, including time, location, device data, and spending patterns, to determine if the activity aligns with the customer's normal behavior. They may also analyze authentication methods used, such as PIN entry, passwords, or multi-factor authentication, to assess whether proper security credentials were applied. Another key step involves gathering evidence. Banks may request additional information from the customer, review merchant data, and collaborate with payment networks or other financial institutions. In some cases, they also rely on fraud detection systems that use advanced analytics to identify anomalies and flag high-risk transactions. The blog highlights that timelines and outcomes can vary depending on the complexity of the case. If the transaction is confirmed as unauthorized, the bank will typically reimburse the customer and may pursue recovery of funds through chargebacks or further investigation. However, if evidence suggests the transaction was authorized or resulted from negligence, reimbursement may not be guaranteed. Ultimately, the blog emphasizes that prevention is just as important as investigation. Banks increasingly rely on AI-driven monitoring and real-time fraud detection to identify suspicious activity early and reduce the likelihood of unauthorized transactions occurring in the first place.